I've been the only one saying it. Now I'm seeing other people starting to gravitate towards it a little bit, but for a year I've been saying that I believe the US government wants gold to go to the moon. I really do. But they have to do it the right way. Because rising gold is the only way, first and foremost, to devalue the dollar. When you talk about a dollar index is a basket of melting ice cubes that you're measuring the dollar against, because let's first define Triffin's dilemma. It's a dilemma that says as the reserve currency, you'll always run trade imbalances and never have a manufacturing base, because never have a positive trade balance is really what it says, because the world at large, if you are indeed the world reserve currency and every country on the planet needs dollars to buy energy, amongst other things, we don't trade with all those countries. So how do they get their dollars? They sell them in the open market, their currency, to buy dollars, creating a massive discrepancy between the dollar and other currencies. The example I often use is Cambodia. Don't trade much with them, so Cambodia sells their currency in the open market to buy dollars, to buy energy, and to do other things. So over time, that discrepancy gets to a point where someone says, let's send our manufacturing over there, we'll make 10x. This is how the manufacturing facilities in the United States got hollowed out. So you can't be the reserve status, number one, if you want to have a trade surplus. And if you're going to measure the value of the dollar globally, measure it against nothing but gold, which is the neutral barometer, the neutral measuring stick against measuring any asset or any currency. And when Roosevelt confiscated gold in 1933 and paid everyone $20.67, which was a 67-cent bonus above the $20 that they traded in, which was a lot back then in 1933, he then devalued the dollar by 40%, making it 35 bucks an ounce. You devalue the dollar by rising gold. So let's just put that as a baseline. And the assumption that if they do want to reindustrialize, like Trump keeps talking about, then you must move away from the reserve status. Now, as crazy as that sounds, Anthony, the previous economic advisor to the Biden White House, Jared Bernstein, wrote a report on it, Dethrone King Dollar. We can't be the reserve status, he argues. We can't be the reserve currency, he argues, because we've squandered the opportunity and we've hollowed out our manufacturing, and it is now a hindrance, not a benefit. Well, Vice President Vance has echoed these exact same concerns publicly. Can't be the reserve currency anymore. They throw out these little clues, these crumbs, which I believe to be true. As a matter of fact, we can't afford to do it and have a manufacturing base. So how do you put our kids back to work in an environment where jobs are disappearing, where cost of living is getting higher, and where AI is going to take a profound impact on an economy that is undereducated? And from a number standpoint, you know, the population is actually getting smaller, right? So what do? How do you bring back manufacturing? So step number one, you have to let gold go higher, but really step number one in front of that would be, how do you get the gold back? Well, for the past 19 months, we've been seeing massive deliveries on COMEX. Some people say, well, but not all of it's leaving COMEX. So is it just games being played? Fair question. Some leaves. And this is true for silver too. You know, 39 million ounces of silver drove out of COMEX in February after 26 million ounces were delivered that month. 160% of what was delivered left. That's 3 million pounds nearly of silver worth $4 billion. Who the hell took possession of that? Now, silver is a critical mineral. But what if it was national security and Secretary Bessent, who is the chairman of the Exchange Stabilization Fund, could say, yeah, silver is a critical mineral. We are going to bring in silver. And you know what? We deem gold to be for national security. Therefore, we don't need congressional approval. We'll keep this on the down low. How do we get all the gold back without having our footprints in the snow for everyone to see what the U.S. is doing? Well, the first thing, we'll talk about the commercial banks. We have seen massive amounts, over $20 billion worth of gold delivered in February, $14 billion delivered in June. Every single month for 19 straight months, we've seen 9 to 10 figures worth of gold delivered every single month. Billions upon billions upon billions upon billions in physical numbered bars delivered, not rolling the contracts, not paper settlement, physical bars. Now, Okay, what does that mean? That means that in 35 years I've done this, less than 1% of contracts ever stood for delivery. The COMEX market is a system by which you hedge exposure to a company like mine who has, 1,000,000 ounces of silver in the warehouse will sell 1,000,000 ounces on COMEX. We're market neutral, and we unwind as we sell so that we're not speculating. A producer of gold can forward sell his production. A farmer who plants a field in April can sell the wheat production to the baker who needs the flour in September. This is to offset risk on all parties. It's not to stand for delivery, but you can. Since Trump won the election, deliveries are so far outsized and out of their anomalies, their outliers. It's like 4 feet of snow in Death Valley in July. Every month, and no one's saying, who the hell's doing this? Every single month, who is standing for delivery? Don't tell. And the fact that it isn't all leaving COMEX, people dismiss it. Well, what if it was the Exchange Stabilization Fund through the commercial banks who do work on behalf of the central banks, and they say, we want to stay at arm's length, keep it in your account. If we pull it out and send it to Fort Knox or wherever we send it, it's going to create too much of an uproar. We will slowly take it out. Now, again, this is speculation, but the U.S. Treasury doesn't have to worry about any issues with rehypothecation. I assure you that. So what if all of this gold that has been coming in for 20 straight months nearly has been largely the Treasury Department? Same thing with silver. National security issue, Exchange Stabilization Fund, Scott Bessent, who understands gold. It was his largest holding. He gets it. He says, we need to do this. Let's bring it all home. Let's quietly bring it back. We'll leave it in COMEX. The volumes on the eligible category will spike. People will think, oh, it's being replenished. Everything's good. I don't. This is not what has normally happened. This is way, way unusual. Let's look at the other side. Now, okay, so the gold's here. We know that. What would be the next step? The next step would be to devalue the dollar by rising gold. Now, how would you allow that to happen? Well, that's the Genius Act. And the Genius Act says that anytime money moves anywhere from next January forward, globally, it will be on a blockchain network, right? Backed by stablecoin. And those stablecoins will be backed by primarily 90-day or less US Treasuries, right? This is number one, creating synthetic demand for the short end or the front end of the curve for US Treasuries. Now, this also matters as an aside if Trump were out to, as many people believe, deal with the US Federal Reserve issues that he believes, I think, that they're part of the root of the problem. And in order to deal with them, the first thing to do would be to, in essence, neuter one of their dual mandates, that is of the short-term interest rates, the overnight lending rate. If any time money moves, according to the Genius Act, it's backed by 90-day or less treasuries. Whether you're buying a pack of cigarettes or a new house, you're creating massive demand for the front end of the curve, which will pin the short-term interest rates to the ground. Pin them to the ground, thereby neutering the dual mandate of the Fed. And Warsh has already talked about wanting to get rid of the full employment mandate. I mean, are they up to something there? That's just as an aside. But so you've now created insanely synthetic demand for short-term treasuries, 90-day or less. Because anytime money is moving anywhere across the globe in US dollars, this is how it will move. Now, the primary issuer of US treasuries is Tether. We know that. And first of all, Tether added another 14 tons of gold in the second quarter. They have over 20 billion, or pretty damn close to 20 billion in gold. More gold than anyone in the world but central banks. In fact, the only entity on the planet that has bought more gold officially. Now, a lot of the central banks buy stuff unofficially. In fact, they claim they bought 16 tons the first quarter. The World Gold Council said you're lying by a factor of 15. You bought at least 244 tons, the largest amount central banks have ever bought ever in a first quarter. And they're doing the same thing again, another 290 tons in the second quarter. It's the largest quarterly addition in several years anyway. But anyways, the central banks are buying it nonstop. Tether's bought more gold than anyone but Poland in the last 2 years, even more than China. Now, Bo Hines was Trump's confidant and crypto czar through last August, a year ago. He is now the CEO of USA Tether. Food for thought. Tether was in trouble for a while by the Justice Department, I thought. All of a sudden, Tether's opened up their back door. We saw this by them identifying wallets related to the IRGC and Becent, saying, yeah, we blacklisted those smart contracts or those stable coins at the smart contract level. They won't work anymore because we see it's from the IRGC. So in other words, Tether said to the Justice Department or to the Treasury, we flag these. Here's what you can stop them, and which is a whole other issue altogether, the programmability of these stable coins. So they've gotten into bed with the U.S. Treasury. Now they got Bo Hines as their CEO. They bought more gold than anyone using the interest because it's not transferable on these treasuries. That's the key. Remember, the Treasury has interest, and the holder of the stable coin or whoever he passes it to buy something, if I owe you $1,000, a stable coin will be created in January. Short-term Treasury is bought behind it. When I send it to you, the stable coin is burned. The interest on that Treasury does not belong to either of us. The issuer keeps it. So what do they seem to be doing with all of this? They own more treasuries than just about anybody, or hold more treasuries. They're buying gold with it. And what does that do? It devalues the dollar, pushes gold much, much higher. Now, if I wanted to speculate and say, well, they're doing it on COMEX, not through an official channel, but through the proxy banks, JM, Citi, Goldman, et cetera, why not keep it at arm's length here too? Work out a deal with Tether. You guys are going to do this. You're not going to be hassled by us. You're going to make gazillions of dollars. You're going to quietly sell that gold to the Treasury Department over time. But now we're at arm's length, no footprints in the snow. You're going to continue to buy gold every time dollars move. You're going to take that interest and buy gold, which devalues the dollar globally, pushes gold much, much higher. You sell that gold to the Treasury, which then it gives us more equity against our debt, allows a devalued dollar to slowly pay down the debt much more easily, gives us a shot at it. But more importantly, we're quietly defaulting on the reserve status. In other words, we're giving up on maintaining a strong dollar policy. We want a weak dollar to reshore manufacturing and give us a shot at producing more than we consume so that our children and our grandchildren will not be prisoners to the indebtedness that we have created, and give them a shot to actually grow their way out of this problem over time. You cannot be the reserve currency with a strong dollar. And if they worked out this deal with companies like Tether and maybe the other issuers, JP and Citi and Goldman and Visa, they'll all issue stable coins. What if the deal is, we want you to all put a portion of that into gold and sell the gold to the Treasury and keep the Treasury out of it? Maybe it doesn't go that far, but maybe Tether is involved in it. They were in trouble. They're not. They opened up their books to the Justice Department and allow it to be programmable. Bo Hines is now the CEO there. They're buying more gold than anybody. They're not very open about it. What if that gold quietly gets sold to the Treasury over time? It's going to devalue the dollar if they keep doing this and give us a shot at reshoring manufacturing. That's my thesis. Now, when Judy Shelton threw out her gold bond theory, it connected the dots in a way that, I mean, I still hope it happens. Because now if you sell zero coupon bonds redeemable in gold, and entities like Tether keep pushing the price of gold higher and higher and higher and higher, zero coupon bond meaning it's redeemable in gold at a face value amount in 20 years. So today, 4,000 or a $20 million bond would be what, like just under 5,000 ounces of gold. Van Eck Funds came out recently, the mutual fund company, and said their emerging market bond team, theirs, not mine, said if the dollar did lose reserve status, gold could go, we see our research says go to 139,000 at least. Well, 139,000 into 20 million in 20 years is about 130 or 40 ounces, whatever the number is, not 5,000. So in other words, you let the dollar fall, let gold go higher. If it were backing the bonds, like Judy said, maybe they'll do it. It's a slam dunk, in my opinion. But the whole idea is to reshore manufacturing and give us a shot at paying down the debt in watered down dollars. You go the other direction, you have two options: inflate or default. Because if you produce less than you consume, there is no pathway. And when we are shrinking the amount of high-paying jobs, that's a problem.